Previously on Retire Ready, the next chapter.
For decades, my days had a rhythm: income, investments, risk, legacy. There are so many moving parts. Back then, the world felt simpler. I realized that retirement wasn't just about stopping work. It was about starting something new, something meaningful.
Are you sure that my savings will last?
Is CPP really enough to retire on?
Taxes keep rising.
RRSP? RIF? I don't understand the difference. Can I help my kids?
It's time to retire ready and enter the next chapter.
I'm Peter Guidote, Chartered Accountant, Certified Financial Planner, and Senior Portfolio Manager at CG Wealth Management. And in this video, we'll talk about Canada's 4 government pension sources: the Canada Pension Plan, the Quebec Pension Plan, Old Age Security, and the Guaranteed Income Supplement. So let's get started.
I remember seeing my first pension deduction and thinking, well, there goes lunch money. But over time, I understood why they would deduct for CPP, or in my case, QPP, as the quiet engine behind my retirement. It's not flashy, but it's reliable. And when Elaine and I started planning our retirement seriously, it was one of the first things we looked at. It's funny. You spend decades paying into something, and then suddenly it's time to decide how and when to take it back.
The Canada Pension Plan and the Quebec Pension Plan are the backbone of retirement income for most Canadians. They're contributory programs, which means you only receive benefits if you've paid into them through employment or self-employment. And yes, if you're self-employed, you pay both the employer and the employee portions.
I worked in both Ontario and Quebec during my career, so I assumed I might qualify for both CPP and QPP. But it turns out your pension is based on where you retire, not a combination of where you worked. Since I retired in Quebec, I received QPP. It's a small detail, but one that's worth knowing early on.
CPP and QPP are designed to serve the same purpose, providing retirement income based on your working years. But they're administered separately. Quebec chose to manage its own pension plan when the CPP was introduced in 1966, and that's how the QPP came to be. The differences between them are mostly administrative. QPP contribution rates have been slightly higher than CPPs in recent years, but not by much. The most notable distinction is flexibility. While CPP benefits must begin no later than age 70, QPP allows you to defer until age 72. That extra 2 years can make a meaningful difference for those who want to maximize their pension. Still, in terms of how they calculate benefits, how contributions are made, and how they integrate with other retirement income, CPP and QPP function very similarly. If you've worked in Quebec or outside of Quebec, your contributions are tracked and coordinated between the 2 plans, but you'll receive benefits from the one that applies to your province of residence at retirement.
Elaine and I had built up a solid RRSP over the years, so we decided to delay our QPP and OAS until age 70. Letting those benefits grow quietly in the background gave us more flexibility, and frankly, we didn't want to leave behind a large RRSP balance that would be heavily taxed if something happened to us. By waiting, we secured a higher monthly income for our later years, when health costs and stability matter more. Now, not everyone's in the same boat. A close friend of mine didn't have a large RRSP to fall back on, so he started his QPP at 60, and that made sense for him since he needed the income right away. Retirement isn't one size fits all. You make the best decision based on your own situation, and it's not always obvious, which is why I am very thankful for our advisor's guidance.
Deciding when to start your CPP or QPP is one of the most important retirement choices you'll make. You can begin as early as age 60 or delay up to age 70 for CPP and up to 72 for QPP. The timing affects how much you receive each month. So if you start early, your pension is reduced by 0.6% for every month before age 65. That's a 7.2% reduction per year, up to a maximum of 36%. On the other hand, delaying increases your benefit by 0.7% per month, or 8.4% per year, up to a maximum of 42%. So let's look at a simple example. If your CPE or QPP benefits is $1,000 per month at age 65, starting at age 60 would reduce it to about $640. But if you wait until age 70, your monthly benefit could rise to around $1,420. That's more than double the amount you receive at 60. The right choice depends on your health, your income needs, and your other retirement resources. If you're still working or drawing from savings like an RRSP, delaying your pension can help you avoid higher taxes and build a more secure income stream for later in life.
After I turned 65, I didn't stop working right away. I eased into retirement. A few consulting projects here and there, mostly to stay sharp and keep a routine. But I made the decision to opt out of QPP contributions. At that point, I was already drawing from my RRSP, and I didn't see the value in continuing to pay into the plan. Instead, I redirected that money into my TFSA. It felt like a smarter move, more flexibility, and no tax on the growth.
Whether you're employed or self-employed, contributions to CPP or QPP are required as long as you earn more than the basic exemption amount, currently $3,500. Above that, you'll pay premiums up to a maximum pensionable earnings limit, which adjusts annually. For employees, the cost is shared between you and your employer, but if you're self-employed, you're responsible for both portions, which can be a significant expense. Since 2019, both plans have introduced enhanced contributions to increase future benefits. Now, these additional premiums apply to higher earnings and are meant to help future retirees receive up to 1/3 of their pensionable income, up from the previous 25%. However, these changes will not be felt by those retiring soon. The full impact of these enhancements will be realized gradually over the coming decades, benefiting younger workers who are contributing under the new structure. If you're working between ages 65 and 70, you can choose to opt out of contributing by filing a CPT 30 form if you're employed, or using Schedule 8 on your tax return if you're self-employed. But remember, contributions are mandatory if you're under 65 and still earning income.
After I started receiving my QPP, I kept working part-time for a while, mostly to ease into retirement rather than stopping cold turkey. I looked into the post-retirement benefit, and while it sounded useful, the numbers didn't quite add up for me. As someone self-employed, the extra contributions were steep, and the monthly increase I'd get in return was minimal. It would have taken me over 2 decades to break even, so I opted out and focused on making the most of the income I already had.
So if you continue working after you begin receiving your CPP or QPP, you may be eligible for a post-retirement benefit or PRB. This is a small additional pension amount that's earned through continued contributions while receiving your retirement benefit. The PRB is calculated based on your earnings and the portion of the maximum pensionable earnings you've contributed. Because of the long payback period, the PRB is generally more beneficial for employees than for self-employed workers. But it's important to weigh the cost of contributing against the value of the benefit, especially if you're only working part-time or nearing age 70.
When Elaine and I looked at our retirement income sources, we realized we didn't need OAS right away. Between our RRSP withdrawals and my part-time consulting, our income was already high enough to trigger clawbacks. So we made the decision to delay OAS until age 70. That way we'd receive a larger monthly benefit later when our other income streams would naturally taper off. It felt like a way to build in more security for the years ahead without giving up anything we truly needed in the moment. Now, as I said before, this may not be the right decision for everyone, but since we didn't want to end up with a high estate tax upon our passing later on, it felt like the natural thing to do. Gradually melt down our RRSP to take it form the taxable bucket, even if we didn't necessarily need to spend it right away.
Old age security is a universal benefit available to Canadians age 65 and older. But to qualify, you must be a Canadian citizen or a legal resident at the time of application, and you must have lived in Canada for at least 10 years since turning 18. OAS is paid monthly and indexed quarterly to keep pace with inflation. The benefit is taxable, and for higher income earners, it may be subject to a clawback, officially known as the OAS recovery tax. In 2025, the clawback threshold was $93,454. So if your net income exceeds that amount, 15% of the excess is deducted from your OAS payments. But you can also choose to delay your OAS up to age 70. For each month you defer, your benefit increases by 0.6% to a maximum of 36%. And this can be a strategic move for those who don't need the income immediately and want to secure a larger inflation-protected benefit later in retirement. OAS is designed to complement other income sources like CPP or QPP. While CPP and QPP are based on your work history and contributions, OAS is based on residency. Together they form a layered foundation, one that helps ensure a steady stream of income throughout retirement, regardless of your employment background.
When I first heard about the OAS Clawback, I didn't think it would apply to me. But once I started melting down my RRSP and still had part-time income coming in, I realized I was well above the threshold. That's when Elaine and I decided to delay our OAS. We didn't want to lose part of the benefit just because our income was temporarily high. Timing really does matter.
The Old Age Security Recovery Tax, commonly known as the OAS Clawback, is triggered when your net income exceeds a certain threshold. For 2025, that threshold was $93,454, and it will be adjusted to inflation every year. If your income goes above that amount, 15% of the excess is deducted from your OAS payments. Now, this clawback is calculated annually based on your tax return, and because the OAS benefit year runs from July 1st to June 30th, any repayment affects your benefits for the following year. That means a one-time spike in income, like selling a property or withdrawing a large sum from your RSP, can reduce your OAS for months to come. So it's important to plan ahead. If you expect a higher income year, you may want to delay OAS or spread out the withdrawals to stay below the threshold. And if you do end up owing the clawback, it will appear on your tax slip and can be claimed as a credit against other taxes payable.
My mother received the GIS for years. It wasn't a large amount, but it made a real difference. Enough to cover her groceries and still treat her grandkids now and then. It gave her a sense of independence, and I was grateful she had that support.
The Guaranteed Income Supplement is a monthly benefit available to low-income seniors who receive old age security. It's non-taxable and based on your previous year's income. GIS is designed to provide additional support for those who need it most, helping cover basic living expenses and maintain dignity in retirement. Now, while it doesn't apply to everyone, it's an important part of Canada's retirement safety net, and for those who qualify, it can be a meaningful addition to their monthly income.
Elaine and I have QPP, OAS, RRSPs, TFSAs, a small rental property, and my part-time consulting job that I am slowly winding down. Each pillar behaves differently, and each one plays a role. Our advisor helps us decide when to draw from what. I've come to think of it like a symphony. Each instrument, each account has its own sound, but without a conductor, it's just noise. Our advisor is that conductor, and thanks to her, our retirement plays in harmony.
Most Canadians will rely on a mix of income sources in retirement, not just CPP, QPP, or OAS. Personal savings play a critical role, and these include RSPs, TFSAs, non-registered investments, and rental income. But the key is coordination. Each source has its own tax treatment, timing considerations, and impact on government benefits. For example, withdrawing too much from an RSP in a single year could trigger an OAS clawback. On the other hand, TFSA withdrawals are tax-free and don't affect your eligibility for benefits. According to McKinsey's study, 83% of Canadians are on track to maintain their standard of living in retirement, and even low-income households can maintain up to 93%. But that outcome depends on thoughtful planning. Reviewing your strategy annually, especially as your needs and incomes change, helps ensure you're making the most of every dollar. In our next episode, we'll explore how to budget and maintain financial control in retirement so you can make the most of what you've built. And if you found this video helpful or interesting, consider subscribing to our channel and hit the like button. Also, be sure to subscribe to our newsletter to receive the free Estate Record Keeper. It's a guide to help you organize your estate for your loved ones. And if you have any questions, click on the link in the description below or scan the QR code on the screen to book a free strategy meeting with a member of our team. And finally, remember to be kind to yourself and to others, and I'll see you in the next video.